Hey, if you haven't done so already, like Sarah from Chicago did, you can go to yourmoneyyourwealth.com. You can scroll down, and then it says Ask Joe and Al on the air button. Hit record, and then you can ask us a question. Let's see what Sarah from Chicago had to say.
Hey there, I'm Sarah from Chicago, and I have a quick tax question. I make too much to deduct any of the contribution to a traditional IRA. And my question is, if I have to pay regular income tax on deductions in the future, how does that benefit me rather than paying capital gains in a regular investment account? Thank you guys, and love the show.
Huh. Well, thank you, Sarah. Love that you love the show.
Yeah, me too.
All right, so she's making too much money to deduct any contribution from an IRA. So she's saying, hey, if I have to pay regular income tax, on the future growth, if she doesn't take the deduction going in an IRA, what's the difference? Why don't I just go after tax and pay capital gains tax? That's a really good question, and I'll take a first stab at this.
Okay.
Sarah, what I would like you to do, if you have too much money that you cannot take a deduction from a traditional IRA, maybe you have income that you can contribute to a Roth IRA. Because the income limitations for a traditional IRA, it depends on if she has an account, if she's married and the spouse has a retirement account at work.
Yeah, so here, let me help you out, and then we'll come back to you. So if you're single, by the time you make $64,000 of income, it starts phasing out. It starts phasing out. And by the time you get to $74,000, it's fully phased out. That's if you're subject to or included in an employee retirement plan. If you don't have an employee retirement plan, there's no limit on the deduction in terms of income. Now, if you're married,
when the spouse has one, it's the same as the Roth.
Yeah, that's right. It's $193,000 to $203,000. So in other words, that's where you can take the deduction, right? But
so I guess it depends on your income. So if you're in those income ranges, if you're under, married under 203. You can still make a Roth IRA contribution?
Yes. And if you're under $193,000, you can do a full Roth IRA contribution.
So I guess that's where I would start. If you're still over that, it still might make sense to do a non-deductible IRA contribution, but then convert it into a Roth IRA because there is no income limitations on Roth conversions. The only problem with that strategy is that the pro rata and aggregation rules. And what that means is this, is that you have to take a look at the aggregation of all of your IRAs together. So if I make a $6,000 IRA contribution and convert it, that's fine as long as that's the only IRA that you own. But if you have another IRA that's worth, let's say, $93,000 or $94,000 is a better number because you have $6,094, so that's $100,000 total in IRAs. So 6% of your contribution, right, is $6,000 of $100,000 would be roughly 6%.
That's right.
And if you did that conversion, only 6% of it would be tax-free because they take a look at the aggregation of all, and then they prorate it. So it's a tough question. If that's the case, if you have a lot of other IRAs, then yeah, maybe probably going into a non-qualified account and be a very tax-efficient investment and just pay capital gains rates.
Yeah, excuse me. I would agree with that. And so one other thing, if you have a bunch of money in an IRA and you have an employer that has a 401k that allows you to roll IRA money into the 401k, there is a strategy where you can take that IRA money, the pre-tax money, and roll that into the 401k, and then you're left with the after-tax money with what you just said, Joe, and then you can convert that. So that is a potential workaround on that one.
So first things first is you have to identify, all right, what is your adjusted gross income? Do you qualify for a Roth IRA contribution? If you do not qualify for a Roth IRA contribution, the second step would be make a non-deductible IRA contribution and convert it only if you have no other IRAs. If you have other IRAs, then you would want to calculate what is the total balance of all my other IRAs. And I were to guess, if it's more than $50,000, $100,000, Then maybe you make your savings into a non-qualified account.
Yeah, which means non-retirement. And the reason is because your non-retirement account, you get special capital gains treatment, which is a lower tax than any gains in an IRA.
And today, you could be very tax efficient in that account. You can go into, let's say, a total U.S. stock market index fund. Those are very tax efficient because there's not a ton of turnover there. Or S&P 500 fund. You could go into just, I don't know, large cap, small cap, whatever that you want to do. But I would do an ETF index fund, passively managed institutional type fund, something like that that has very little turnover. Be careful with the investments that you choose outside of a retirement accounts. If you have more of an active strategy where someone's trying to time markets and pick stocks inside the mutual fund or a money manager, you're going to see a lot more turnover within that because they're getting in and out of the market, or they're getting out of individual securities at certain time frames throughout the year that could kick out short-term capital gains, which would be taxed at ordinary income. They could kick out long-term capital gains that you'd pay tax on, even though you're not necessarily enjoying the income from it. So just be careful on the investments that you choose outside of a retirement account to make sure that it's tax efficient, because it's not necessarily what you earn. It is what you keep.
Yes.
It's what you keep, Alan.
I agree with all of that.